Warren Buffett has been quite active in the latest financial quarter, investing a total of $13.7 billion into the stock market. In today's video, I'm simply going to be breaking down what those investments were, as well as how you can go out and interpret these kinds of investments for Berkshire Hathaway in the future, and also any other business that you want to assess in terms of what internal investments they are making. First of all, I just want to explain where I'm getting the data from that I'm using in today's video, and that will help you be able to find this data for any public company that you're looking to analyze. Every quarter, US public companies release a quarterly earnings report called a 10Q, which includes the financial performance of the business over the past 3 months. And within this 10Q, the quarterly filing, we can find a financial statement called the cash flow statement. And this statement basically shows us all of the cash in and outflows of that business, money coming into the business from their various activities, operations, and money going out of the business in a number of different ways, in terms of their operations, in terms of paying their staff and paying for inventory, but also in terms of their investments, where they've spent money to invest in assets, whether that's for their business or whether they're stock market investments in Berkshire Hathaway and Warren Buffett's case. And then, of course, money that is coming in from investments as well. Money where they've sold some investments and received cash back. The easiest way to find these reports is to go to the investor relations page of the company's website. And within that page, there will be a section called SEC filings. Click on that section and then search for the 10Q, and that will show you all of the quarterly reports for that company. Now, there's one more step that makes it a little bit more complicated when it comes to quarterly financials. You would expect that the quarterly report would show you the cash in and outflows from just that quarter. But because we're now in the third quarter, the quarterly financials on the cash flow statement within that 10Q is actually showing us the cash in and outflows from the past 9 months, from Q1 to Q3. So if we want to figure out what movements of cash have happened just in the last 3 months, just in Q3, then we need to do a subtraction between the last 9 months, which will be found on the Q3 quarterly report, and the first 6 months of the year, which will be found on the second quarter, the Q2 quarterly report. For example, if a company had a cash outflow of $100 million for the past 9 months on their third quarter quarterly report, remember it's showing us the first 3 quarters of the year, and then let's say we had a look at the second quarter report and they had a cash outflow of $60 million, and that we know that that $60 million is for the first 6 months of the year, Q1 and Q2, then we can look at the difference between that $100 million and the $60 million, and we now know that $40 million of that cash outflow occurred in the third quarter. Now, I'm sure there's tons of people watching this video that would love to go out and now figure out the difference between those two and calculate the cash in and outflows of a business, but there's also probably a lot of people who don't want to go out and do all of that grunt work. So that is what I'm here for today. We're going to talk about what happened with Berkshire Hathaway, Warren Buffett's company, in terms of the investments that they made in the third quarter. The first major cash flow to note for Berkshire Hathaway is a $9 billion outflow for acquisition of treasury stock. This is a section in the financing activity section on the cash flow statement. And whenever you see acquisition of treasury stock or share repurchase or share buyback, all of those things mean the same thing. It means that the company has spent some of the company's cash and has repurchased stock from the public markets. And what that basically does is, of course, the company's cash goes down because they're spending money on stock. But when they repurchase that stock, it essentially gets deleted, meaning that the total number of shares outstanding goes down. And it means that the value or the percentage ownership for each share goes up. So again, just to give you a simple example, imagine that you had 1 share out of 10 total shares. So a business on the public markets had 10 total shares and you had 1 share. That would mean you had 10% ownership. You could then imagine that the company repurchases or buys back 2 shares. Okay, now you have 1 share out of 8. So you have the same number of shares, but you have a bigger percentage of the company. It's like the pizza, the pie has been cut into a smaller number of pieces. So your one piece is now a larger piece of the pie. And I think the most important thing to understand when it comes to share repurchases, as confusing as it can be, is you should think about it in the same way as if you were personally buying the stock. Okay? They're very much the same thing, not exactly, but it is pretty much the same thing as if you were to go out and take some of your money and buy more stock, as if the company spends company cash to repurchase stock. Here's how. So let's first explain what happens when you personally buy more stock. So this should be pretty easy to understand. When you buy stock, the cash in your bank account goes down and your percentage ownership goes up, right? Because you now have more shares. Your ownership has gone up, your cash has gone down. And of course, when this happens, you would want to make sure that the ownership that you just gained brings you more cash than you initially gave up to buy the shares. If you paid $1 per share, for example, to buy a stock, that's $1 leaving your bank account per share, then you would want that business to bring you back more than $1 per share, right? It's the basics of investing. And the same thing is true when a company repurchases stock, okay? Cash in the company's bank account goes down and your percentage ownership goes up because there's less shares in total. So again, you only want the company to do a share repurchase when the increased ownership that you get brings you more cash back than the cash that was given up by the company. Because if a company does a share repurchase and they spend some money that's in the bank account for the company and your ownership goes up, but then it doesn't deliver you more than they spent on those share repurchases, then you would have been better off if the company just gave you that money as a dividend, right? The company is making a decision to repurchase stock rather than paying you a dividend or investing within the business. So you want to make sure that it is a worthwhile investment in the same way that you would consider investing in a company using your own money in your own bank account. Far too often, you will see companies that repurchase a ton of stock regardless of what the stock price is. And this is incredibly bad for shareholders because while yes, your percentage ownership does go up, that's not the only impact. The other impact is that the company has substantially less money to pay to you as dividends, for example, as I just mentioned, but also to invest in actually growing the underlying business. A company should only be repurchasing stock if they are getting a good deal. And by a good deal, I mean that there is a good relationship between the price they're paying and the gain that you get from that extra ownership, and that there are no other better internal investment opportunities. And the exact same thing applies to you personally. If you are buying a stock, you should be buying it because the price that you're paying is far lower than what you reasonably expect to get back from that business over the next few years. And at the same time, you should be buying that stock because there are no other better opportunities. If there's a better opportunity that you see, then why would you buy that stock? You would buy the better opportunity. So the same thing applies to businesses. And that's how you can assess whether a company is making a good decision. In the same way as you would. You can look to the business, see what price they repurchased the stock at, and say, would I have repurchased the stock at that price? So that accounts for $9 billion of this $13.7 billion that Warren Buffett invested. So where is the rest? Where's this remaining $4.7 billion? So the $4.7 billion was money that was spent on equity investments during the past 3 months. And that $4.7 billion is a net increase. So I'm taking a comparison between the money that was brought in from their investments and the money that went out from their investments. And the difference was 4.7, which means they added $4.7 billion to their equity investments during the past 3 months. Unfortunately, we do not currently know what those investments were specifically. And the reason why we don't know is because Berkshire Hathaway has yet to file their 13F filing. Now, the 13F filing is different to the quarterly report. It is something that big businesses that invest a lot of money in the stock market, they need to do this every quarter. And it is this filing that will tell us the specific trades that Berkshire Hathaway and Warren Buffett made during the past quarter. Now, these filings are expected to come out on the 14th of November. So if you're watching this as soon as this video was released, they may or may not be out. If you're watching this way after the video was released, then they are probably out. And I will be making a video covering Berkshire Hathaway's trades that will be listed in this 13F filing. So if you're watching this at a later date, or even if you're watching this on the date, click over to my channel, hit subscribe so you stay up to date, and check out some of my latest videos, and you will probably see that I've done a video covering that $4.7 billion investment, and we can discuss some of those investments around Berkshire Hathaway and what are my thoughts on them in terms of giving a value investor's perspective on a value investor's purchases. But that's all for today's video. I hope you enjoyed it, and as always, I very much appreciate it if you did enjoy the video, if you could leave a like on it, and then head down to the comment section and let me know your thoughts down there. And of course, hit subscribe if you haven't already. We're almost at 50,000 subscribers, which is a huge milestone for me. I can't wait till I hit it. We should be hitting it within the next month. So if you haven't subscribed already, please hit subscribe. I'd very much appreciate it. But other than that, hope you guys have a great day, and I'll see you in the next video.